Are we live right now?
Yeah.
Yes.
Okay, this is exciting. Okay, so we are live. Hello everybody. Happy Friday. Thank you for joining us for our first real estate live broadcast. It's such a gorgeous day today with beautiful sunlight, and it's simply perfect for us to start the first of an exciting series. My name is Chang. I'm a principal of JadeStone Real Estate based in New York City in Soho. I personally have been in New York City real estate since 2002 for the past 15 years. I established a real estate JadeStone real estate consulting new company with the mission that establishes the quality brand that every buyer, seller, real estate investor can trust, and we also have Asian clientele in mind. So about this real estate Fridays live broadcast, all on Fridays at 12 o'clock noon sharp. We're going to, through this series, we will invite various experts in their fields to talk about their insights, to share the insights about what's on the market, what's going on with the market, and about the tune-up. So today, I'm very, very excited, very happy to introduce you our very first expert speaker, Tony Yao, the regional manager of Investor Bank, here to share with us everything about the financing that you need to know. And in the meantime, if you have any questions, feel free to send in. And we have 30 minutes. Okay, so I'm going to give this to Tony, our expert for today. So Tony, please tell us a little bit about your background and experience in financing.
Of course. Good afternoon. My name is Tony Zhao. I am the regional manager for Investor Bank's mortgage division, and I have been doing mortgage origination in New York City and Brooklyn mainly for the last 15 years. Most of what we cover are working with first-time home buyers, buyers for investment properties on condos and co-ops in New York City, and I think that working with first-time home buyers is really our niche in the New York City market. We do a lot of condos, we do a lot of co-ops, and over the last few years we've been doing a lot of big multifamily home purchases in the Brooklyn, Bronx, and also Harlem area. And yeah, it's very exciting to be here today. Thank you.
The reason I invite Tony here is that I have worked with so many real estate professionals, and being really on top of each case and knowing where the mortgage, the status, where your case is very important. It's bring a buyer peace of mind. And Tony is always very knowledgeable, very experienced, very responsive, and very, very responsible. And I can really trust whenever I work with Tony. So we have a very first question today, because it is a live broadcast. We are going to have people watch from different places, various degree with various degrees of real estate experience. So can you tell us that for any buyer, the process, what would be like when they submit a mortgage application all the way to closing, that what kind of process they will go through and what kind of timeline?
Of course, and I think it's good for buyers to understand the process, especially in a mortgage process if you're looking for financing. Now, a lot of buyers in New York City are cash, so if you're cash, then things will go easy. But
they will still need to
go
through condo and the co-op process, correct?
Yes. So
yes.
For the regular buyers, I
yes.
think that my book of business is mostly real estate agents. So the real estate agents, what they do is first they send me their buyer.
Correct.
Because what you don't want is to spend a lot of time with
yes.
the buyer And the buyers usually think one thing. They say, hey, I make $150,000 a year. I can qualify for ABC. So banks look at, your income very, very differently. So it is always important that if you are going to get financing, you must talk to a mortgage professional.
Yes.
Because the mortgage professional is going to look at your overall income. If he or she is experienced, he's going to look at, they're going to take a look at your tax returns. They're going to look at your pay stubs, your W-2s, and they're going to figure out how much you can actually qualify for.
Right.
So the first step is usually, the most important thing in my opinion, is the pre-approval.
So we often talk about in New York City, in Manhattan, especially in Manhattan real estate, we make sure to qualify every buyer right from the beginning, knowing that how much down payment the buyer has and when the funding will be in place, and how much financing and purchase power they can have before we can take them out for serious shopping. And in New York City, when you place an offer, what the seller broker would request would include the financial statement from the buyer, saying how much income you have from your basic salary and bonus, other investment or interest income, and how much funding you have in the bank as assets and the liability. That's one part of a document. Then second most important critical document will be mortgage pre-qualification letter, mortgage pre-approval letter, and from the trusted lender, and that's what we're talking about today. So some people, they are actually quite confused about the difference between pre-qualification and pre-approval. So can you tell us, what is the difference?
I think the pre-qualification is a lesser of approval. They pretty much run your credit. They talk to you verbally about what or how much you qualify for. A pre-approval, in my opinion, is a little more serious. For our pre-approvals, we want to see the tax return, W-2 pay stub. We'll take a look at your credit report, and we'll get an overall picture of the buyer so that when you present this pre-approval, you won't have any issues.
Right.
And I think that it's also very important, because we work with such a large Asian community, funds are coming from everywhere.
Right.
They're coming from China, they're coming from Taiwan, Hong Kong. So these are all very important things to understand, that when banks look at your bank statements and you're buying in, let's say, March, banks will want 2 months of bank statements.
2 months bank statements.
2 full months of
Right.
bank statements. Any deposits within those 2 months, they must be sourced. And when I say sourced, it means that if 20,000 came from an account at HSBC, we need to see the account where the HSBC funds came from. So you need to source and season everything.
Right.
So any money coming into the account for the last 60 days, they must be documented. And I think we've had cases where there was an issue to prove these funds because they came from overseas.
Right.
And especially overseas funds, we need to see where they came from, because I think that the CFPB, the Federal Reserve, the government agencies are very tough on audits on banks, because we obviously want to know that this money came here legally, and the fact that it wasn't borrowed from another bank to be used as a down payment.
Okay. So then I'm going to take us back to the process, the overall idea before we get into deeper. So the first-time home buyer, they often are curious about. They contact you, then you're going to ask about their social security number to check their credit and everything. So what would be the next step? When the buyer submits the mortgage application, then the next thing will be the bank will order the appraiser.
So, when I get a phone call,
right.
They're like, hey, I got a call, I got your information from Ang. What I do is I take their...
From Ang?
From Ang. I take their date of birth, I take their social, I take all their information, I take a look at their credit report, I take a look if they're creditworthy.
Right.
And then I send them a small list of documents, usually to have these documents ready. If you're self-employed, 2 years of business and personal tax returns, 2 months bank statements, or any statements that you have where the down payment's coming from. You should tell us how much you're paying for rent, which is rent history, your pay stubs, and your W-2 income. Okay, so that's going to get you the pre-qualification or the pre-approval. After the pre-approval is issued, then it's up to your job and the buyer's job to find that property. A bank these days cannot order an appraisal until you're in contract, because the listing agent's not going to let the appraiser in just for the sake of it. So these are all things that will go to the next step. So this is when the bank sends out disclosures. It's called the original loan estimate. And after the buyer signs all these disclosures, then we can order the appraisal, which will lead to the next approval step, which is the commitment and so on and so forth.
And so after the appraisal is done and the loan document goes to the processing department or underwriting department, are they the same departments?
So the processing department at a bank puts together the documents for the underwriter to review, right? The underwriter is a credit officer at a bank, and their job is to sign off on this money being okay to be released, right? So the underwriter will review everything. They'll review the appraisal, they'll review everything the processor put together, and then the underwriter will approve it or deny it, right? If the underwriter approves the file, then you have what you call a commitment. So a commitment is the bank's willingness and commitment to you to lend on this specific deal.
So for the commitment letter, it's a very important document for us to submit along with condo or co-op bull package. Everybody, especially when you purchase in Manhattan, you either purchase co-op, you purchase in condo. Of course, some people purchase the entire townhouse, that you don't have this issue. So in the bull package, mostly the buyer broker will put together the document that include a lot of various required documents, and we do not submit it until the bank issue commitment letter and send to the management. So when the commitment letter usually means, Tony mentioned, is that bank already look at the building that you want to purchase, and also they already assess the buyer's personal profile. So that's commitment. So Tony mentioned one thing that I want to just jump in, because I don't have any specific flow, but whatever, I just want to ask some question about different buyer. The credit, why is credit important, and at what number you will consider it's a good credit? Would that impact the rate?
Yes. So a bank looks at credit for one reason. They're going to assume that your payment history in the past will continue if they give you a big mortgage. Now, a mortgage is probably the biggest loan that you'll ever take out, because when you buy a home, it's your biggest liability. So if you have a history of not paying things on time, if you can't pay a $100 credit card bill and you've had lates in the past, there's no way that a bank would consider you giving you a large sum of money. Okay, so that is very important to the underwriting and approval process. And yes, rates do differ. If you have a lower credit score, then you're going to get a lower rate, because that money is riskier, right, to get. If your score is higher, then that means you're a very well qualified buyer. So I would say anywhere between 720 to 740 is your ideal credit.
720 to
720 to 740 is where it begins. And anything above that is just pretty much your grade A borrower.
Okay, so 720 as considerably good credit. So I know some people, they are very, very pristine on their credit. So I just want curiosity. Somebody with 800 credit versus somebody with 740. Is there any difference on the rates?
Not much.
Not much.
Not
Okay.
much. Because once you hit the 740 mark, you're really in the same realm, as far as what banks consider
I see.
grade A.
But if you are like 620, then it could be different. Right?
Yes, and you probably wouldn't get a loan.
You only get a loan?
Yes.
Okay. So, in the future, we'll have the credit repair expert here as well to talk about how you can repair the credit, but it's a different story. So, back to the mortgage. Somebody, if they want to switch the job, it basically, my question would be, how far in advance a buyer should prepare? Like if for W-2 employee, we know that normal is much easier than self-employed borrower. So for W-2 self-employed, if they want to switch a job, but they also think about buying, is there any conflict, or what do they need to pay attention to?
So, I'll give you the different scenarios.
Right.
If you've been self-employed, and in the same line of work, and you go from self-employed to getting a W-2, that is always the best case scenario, because banks will use your offer letter from the employer. They will look at your first 2 pay stubs, and they will determine the income that will be used for the file. Now, on the other stream, if you go from, let's say, W-2 to self-employed, even if it's the same line of work,
Right.
you need to show 2 years of self-employed income before you can do a mortgage. So that makes it a lot more difficult because, if you're a W-2 employee and you get $100,000 a year salary, that income is pretty much $100,000 because your W-2, your taxes are being taken out. So what you're representing to the bank is that you're going to grow something 80-something, 100 a month, and that's going to be consistent. Now, if you go from W-2 to self-employed, now, as a lot of self-employed buyers know, you can make $2 million a year, and then after deductions, after depreciations, your net income on your tax returns, they can be significantly lower.
Right.
So when a bank underwrites a loan, they look at your final adjusted gross
Right.
income.
Mm-hmm.
They look at some depreciation. They look at other variances on your business or your Schedule C tax return to come up with the final income. So even if you show that you have $1 million in receipts,
Right.
we can't know what you're reporting to the government as your final net income
Right.
until 2 years of tax returns, or at least 1 year tax return has been filed.
So basically, for the lender, you look at the past 2 years of income.
So
Right.
there are exceptions where if you've been in the same line of work for a long period of time, and I'm not saying all lenders will do this, but we will look at 1 year of business self-employed. So this is something that if you have a strong case,
Right.
we will look at 1 year business self-return. If you go from a W-2 to self-employed, and you can show a history of income producing, and it's actually very strong. So it's really case-by-case basis.
Okay, so you're talking about switching between W-2 and self-employed. This conversation kind of deja vu in my have you talked about this conversation before? So if we just simply talk about W-2, W-2 salary employee, they want to purchase, they want to take a mortgage. Is it ideal for them to switch job to different company before they close, or it doesn't matter?
If you're closing next week, and
Yes.
you change jobs this week, it's going to delay the process. Because what banks do is they need at least 2 pay stubs, usually 1 or 2 pay stubs, before they can actually use your new income. They'll take an offer letter and then 2 months or 1 month of pay stub. So if you're closing next week, that could delay things.
Mm-hmm.
So usually if you're going to switch jobs or switch employment, you should absolutely let the person managing the mortgage, let them know so that they can walk you through the process of how to do it. Job switch is never easy, and especially during a home purchase, you should let the mortgage originator that you're working with know so he can walk you through the process at least let them know. I've had instances where a buyer left a job, and when we went to do the closing, they called and they said, he no longer works here. So I called the client, they're like, oh, I forgot to tell you, I switched jobs. Even though the pay was much higher, it kind of threw us back and it had to delay the process a little bit. So always let the people know that you're working with on the purchase process.
Okay, so let's talk about that's for the W people. And what about somebody who just newly employed? Do they need to work for 2 years in order to get out of the loan, or any minimum years of requirement?
So it really depends on that person. So I'll give you an example. If you've been in college or if you've been in school and you just graduated and you are now employed at, let's say, Goldman Sachs or any W-2 employee, all we need is 2 months pay stubs.
Oh,
I'm sorry,
okay.
2 most recent pay stubs, so it's usually 30 days, an employment contract, and you can start the home purchase process.
Oh, that's good.
Yeah.
That's good.
But if you can't show that you've been in school, I think that most lenders will do a case-by-case scenario to look at why you have not been working for all this time and now you just started working. So they want to know a reason, and if it's a good reason, usually they will do the loan, but it's always case-by-case. But most of the time, the files that I've seen are college graduates who just graduated, they have a new job,
Right.
we get a pay stub or two, and we have an employment letter, and then you can close on your loan.
Sounds very good. So we have a lot of buyers, especially in our Asian community. There are a lot of self-employed as well, business owners. Constantly told me that, and don't worry, I'm fine. I can take out $3 million or whatever. Then when I send them to the mortgage broker, the result is a different story. So let's talk about the self-employed business owner. We know that we all try to deduct as much allowed business expenses as possible. However, the downside is that then you don't have as much adjusted gross income, right? That is what I look at. So, can you tell us what bank look at it? How do you calculate the ability on the loan? Like how do you calculate a self-employed person for the past 2 years, or 2 years average, or when income go up or income go down? What's
So banks will typically do a 2-year average. So for right now, it's a average of 2014
okay?
and 2015. Now, if 2014 was lower than 2015 and 2015 is higher, that is the only time they will take both years, and then they'll do an average of both years. So if 2014 was higher and 2015 is lower, they won't use 2014, they will only use 2015. So this is what banks will always look at,
Wow.
the lower of the year.
I see.
What they look at is they look at what your adjusted gross income is. So it's usually about line 37, 39 on the front page of your 1040s on your personal. And then what we'll do is we will also look at your business returns. We'll see how much depreciation you have. We'll look at the entire picture, where your net profits are, how much we can add back. And I think that on business returns, they're usually a lot more difficult because you want to write off as much as possible.
Right.
So there's little things on the tax returns that a bank can add back. Some we have to take away.
Okay.
So it does vary case by case.
So would it be fair to say that if somebody is self-employed, for that particular reason, I have to rush them to you right away, more so than the W2 person, right?
Yes.
Okay, yeah.
And a banker's job is not to guide
Right,
you on how to file your tax return.
right.
So it's hard to tell somebody to say, hey,
Yeah.
this is how much you need.
Right,
So what I do is I look at how much they earn, and I tell
Right.
them this is what you qualify
Right.
off of, and I kind of go over ratios with them.
right.
So how a bank looks at everything is if you have $10,000 gross income a month, they take 42 to 43% of that gross income to qualify for a mortgage and everything on your credit report.
Okay, so what you just mentioned is the DI debt income ratio. So you mentioned the most allowable is 45%.
So on loans that are smaller, sometimes you can go to 49.99%. That's the debt ratio. And on loans that are jumbo, right, there is something called QM, qualified mortgage. They won't allow you to go up to 42, 43%.
So since you just you mentioned this in the beginning, so can you talk about the conventional loan limit and then jumbo loan, and for today's rate difference?
So anything under 417,000 is considered conforming. Anything over 417,000 is considered high balance, and then once you go above that,
right,
you're into the jumbo territory.
Right.
So Fannie Mae, Freddie Mac banks usually give you a slight discount if it's a jumbo rate versus conforming, which is very odd. For us,
I would think otherwise, right?
Yeah.
So if I take out 800,000 out of my income ability versus I take out 400,000, I would think that I should pay a lower rate on the 400,000 loan, but it's different scenario.
It is different scenario. So if you walk into a bank and you look at they always advertise two different type of rates. You know, your 30-year fixed and then your 30-year jumbo fixed. So you'll usually see about a 0.125 different in rate.
So what's the rate today for 30-year fixed and for the primary residence and versus for investment or jumbo, for example?
So if you look at Investors Bank website, for a qualified buyer who sets up an account, our rate is 3.375 on a 30-year fixed, which is incredible.
That is
on a
very,
jumbo
very, very
high
good.
balance 30-year fixed.
Wow.
Usually for an investment property, you add a half a point to that.
Right.
So I would say 3.875, depending on the client.
Right.
And rates are subject to change, and it's always based on the individual, how strong they are.
Right.
And that's where rates come from.
It's such a good market for the buyers because the rate is so low that you basically a low interest rate empowers your ability, your purchase power to get higher price the property, and also for people, great for people who want to upgrade. Let's say from the studio to one bedroom, or people who've been looking to purchase larger property. It's really, really fantastic, the environment for it.
And I want to add, I'm not a qualified tax person by any means, but if you currently own a mortgage, and you look at the front or the second page of your tax returns, usually under your Schedule A, there's a box that says mortgage interest. You can see how much mortgage interest you actually write off by owning a home. And that's probably one of the biggest benefits. So people say, why should I buy? Why should I rent? That's your perfect example as far why you need to buy. In New York City, you get taxed very heavily.
Yes.
So you need to take as many breaks tax-wise as possible. So if your rate, let's say you wind up with 3.375, and depending on what tax bracket and how much you're able to deduct on your mortgage interest, you can talk to your CPA, your accountant. They can tell you what your realized rate is after your deduction.
So basically, when you own a home versus when you rent, the benefit is that your mortgage interest rate, your mortgage interest is deductible, tax deductible. The real estate tax is deductible, and then your home improvement is also deductible as well. That's very good. My other question is for parents purchase for adult children. What do the bank look at? Because one of our buyer just asked that what do they need to prepare if they want to give the down payment for the adult children? What kind of document do they need to provide?
So if they're just gifting that money, you usually need to fill out something called a gift affidavit from the bank. Because you're saying that I'm not lending this money to my daughter or my son, I'm actually giving it to them. So you're gifting it. So typically you need to show, and again, sometimes you don't need to show the funds where they came from, as long as you show a copy of the check or a wire receipt that it came from your family member along with a gift affidavit. That simply should be enough. So prepare the bank statements, if the bank asks for it, and then a gift affidavit. So when you give the funds to your son or daughter or your child, the child needs to make a copy of it and then make a copy of the funds going into the checking or savings account.
It is any difference whether the parents are local here or foreign national?
Well, I think if it's local in the United States, typically it's a little easier to show. So banks will need, let's say if you're gifting money from China, Hong Kong, Taiwan, you'll need to show where the funds came from. So if you're wiring it from a foreign bank, we need to see some type of proof of where the funds came from and the bank statement most likely.
They need to show bank statement?
Especially if it's foreign these days.
Okay.
So banks are very tough. Not just the banks, the government are tough on banks, on foreign money coming in and real estate transactions.
Okay.
So if it's in a foreign country's language, you'll need to translate it. So I have a translation company that's certified. They translate this for us. And then we'll usually do the conversion because we need to see that as well.
Translate to the English version.
Yes.
Yes. So far, are we good at timing? Oh, it's done. Really? Oh wow, we have 30 minutes. So far we've been only asked talk about the basic level, the entry, maybe the first time home buyers circumstance. I was going to ask Tony about questions for more experienced investors, people who own the second home or own several investment properties. Maybe if you're interested, stay tuned. So my question is that for people who own the second home, does the bank look at differently? Do they see it as investment property, or how do you define the second home versus investment property?
So the most committed FBI mortgage fraud is when
FBI mortgage fraud. FBI.
Is when a buyer says, "Hey, this is going to be my second home," and it's actually not. It's an investment property. Now,
how would it be?
Very easy, very easy. They could come and knock on a door 6 months later.
Do they do that?
I'm sure they do because there are a lot of people that are prosecuted for this. Or they look at your tax returns, right? So if you haven't, I own investment property, I follow Schedule E, right? Because the rent that you're collecting, you don't want to pay taxes on. Or I'm sorry, let me take that back. The rent that you're collecting, you're trying to write off part of it, and you're trying to put that income on your tax return. So if you're saying this is your pied-à-terre second home, why do you now have a Schedule E income? And they don't need to call you, they don't need to do anything. They can just look at something called your IRS transcripts, right? So the federal government, they do an audit, they get the transcripts from the IRS, and then they say, wait a minute, you told this bank that this was an investment or a second home, but you're renting it out right afterwards. So why that is considered a crime is you're putting less money down, you're also getting a much lower interest rate. So you're in fact defrauding the bank from an interest rate and also down payment. So that is something that, in my opinion, I've seen that a lot in my career. And I always tell them what you're risking if you say this is a second home and it actually is an investment property.
So I guess that most of the time what motivates the buyer to decide to claim that as a second home versus as investment property is because of the rates. So what difference would that be?
Maybe a half a point. So on our second home investment, our second home purchase, you can just do it with 20% down. If it's a jumbo, and our rate's 3.375 for a qualified borrower. On an investment property, you probably have to put down a little more, maybe 40, 35, 30% depending on the buyer, and the rate's half a point higher.
Oh, okay. So basically, you need to have more down payment.
Yes.
Because the reason I ask this is that we have a lot of buyer who resides overseas for job or for a national, maybe U.S. citizen, but they work overseas. This in Taiwan or China or London, and they purchase. They want to claim the second home, but in fact they also have this idea in mind that I want to rent it out. So we know the rate will be different, but it's really not that much different, right? You talk about half point. But what about the buyer change the circumstance? Like when I purchase, I do intend to use a second home. Let's say I'm living in Manhattan, and today I purchased a second home somewhere upstate. At the time I purchased, I do claim a second home. That what happened if I want to use it, rent it out? That will be considered as fraud, right?
I don't think it's considered fraud.
Right.
Again, it's really up to the bank and their
Right.
compliance department on how they see it. But if you actually do it,
Right.
your intentions are using it as a second home.
Right.
You do it, you move in as a second home,
Right.
and then circumstances change. Nobody's going to hold you to it. But that's my opinion.
Okay. I'm not going to ask Tony, a professional, some very tricky question. The other, I guess the last question is that one of my buyer also experienced that they own 6 or 7 investment property. Congratulations. But they are having difficulty to try to finance the next one. So my question comes into the two. The first is that how can we know that there are so many experienced investors owning so many properties? How can a buyer to start and take money out of the current investment property, and what kind of percentage they can take it out as down payment for next one and grow their portfolio from there?
So most banks have a limit on how many mortgages you can have.
Right.
So it's usually 4 to 5 investment property
4 to
mortgages.
5.
And then they won't lend you anymore.
That made me lose a lot of clients.
And typically, if they have that many investment properties, they're going
Right.
to claim a lot of losses.
Right.
So at the end of the day, they're not going to have enough income to show to qualify for it. But the very few that do, for cash or taking money out, you can always do a cash out refinance on your investment property.
Okay. So cash out refund is there a big difference on the rate? Because I
Always.
keep asking about the rate because that's most buyers.
I think the rate difference is going to be much higher.
Right.
So it's usually a half a point to 0.75 because not only is it because it's an investment property, you're taking cash out. So rates are usually a little bit higher on cash out refinances.
Okay. So we are 30 minutes really is very, very short. Maybe next time we'll make an hour. So people ask this all the time, and for your insights, your personal opinion, we don't hold you liable for that. What's your opinion? What do you think about the rate? It's going up, going down, or remain the same?
I think I've been wrong half the time, in my opinion. The Federal Reserve did not raise rates, on Tuesday, Wednesday, and they slightly hinted at raising rates in December. That's a possibility. In my opinion, it might go up a little bit, but nothing drastic. It's probably not going to go up to 6-7% like it was.
Right.
So it's still going to help buyers in this market to purchase a home.
Right. So actually, before I came to this live broadcast session, I was on the phone with another broker friend about a buyer from China, and the question is that the rate. So if the rate goes up, Tony just mentioned today's rate is only 3.625. Am I wrong?
For what?
For they say just home buyer
3.375.
3.375. It's really, really historically low. Even the rate goes up a little bit. I think for the demographic, for New York City, for Manhattan real estate market, I personally do not think that rate goes up one tiny bit would have any impact on our price at all. But that's my opinion. The reason for that is because I think our local buyer here financially mostly really qualified and stable, and the impact it might have would be for the buyer more like marginal income that are from a first-time home buyer. So that is just my opinion, and I don't think we should be too much too concerned about the interest rate versus the price. The price will need to go down a lot to offset any 1 point interest increase. So the last question is the investor bank. A lot of people know about Chase, Citi, Wells Fargo. So let's talk about investor bank. So my question is, maybe we have Tony to talk about investor bank and what kind of advantage the buyer can have versus a regular bank.
Of course. So most banks follow a lot of what you call Fannie Mae, Freddie Mac conforming guidelines. Investor bank is a portfolio lender, and if you look at where our rates are, they're typically either the same, if not lower, than your larger institutions. And working at a smaller community local bank, and I stress the fact that we're a portfolio lender. We lend in what they call non-warrantable condos. We actually also do loans in condotels. We'll do a 30-year fix in a condotel. Most banks will not touch a condotel, which is half condo, half hotel.
For example, Trump Soho, 246 Spring Street, it's a famous one.
And we look at the buyer. So if we see the buyer strong, and there's a little thing about them that they won't get a mortgage at a larger lender, we will consider that loan.
Mm-hmm.
So we'll do a lot of loans, and I've been able to lend in a lot of buildings that a typical bank would not do a loan in. When I talk to a new client, the first thing I tell them is that 30 to 40% of buying a home is your income, your assets, and your credit. And the rest is the building itself. That's how important it is in New York City, because each building has financials.
Yes.
So they're like their own human being. So if there's issues with the building, most banks will not lend to that building.
So there are two layers criteria bank look at decide whether they want to give the buyer loan. The first will be the building itself, right? And the second will be the buyer. And so since Tony mentioned about the building, I forgot to ask one very important question, because in New York City we have so many new developments, so many of them. There is an all-time high last year, and especially in Brooklyn and Queens area. When purchase in new development, that won't complete in a year from now, or even in 2018. So how do buyer obtain a mortgage? Think about that, whether they can feel comfortable in securing a mortgage, because we don't know how the rate is going to be.
So yes, we actually do a 9-month lock.
9 months lock versus our regular
30 to 60 days.
30 to 60 days.
That's on new construction loans. One thing that we're very, very unique in, and that separates us, is a new development. For most banks to get in there and start closing loans, the building itself has to be 51% sold or in contract.
Right.
Investors Bank will allow and close the first loan after the building is 25% sold or in contract. That is very unique, and that's what makes us a portfolio lender, because we're not following your regular guidelines from a government-sponsored entity.
Right. So you mentioned about 9 months rate lock. That's amazing. Do buyer need to pay for it?
It really depends on the buyer. Sometimes yes, sometimes no, and it depends on the development itself. So really it's a case-by-case basis.
Wow, great. So the time is short. We won't be able to cover all kind of scenario of situation, always including a lot of interesting stories. But if you have any further questions or more specific questions, we're going to post Tony's contact information on the website. and on the Facebook page. And feel free to contact him. And Tony is really one of a kind. That's why he's here as our first expert speaker. So thank you for joining us.
Thank you.
Enjoy your Friday.
Bye.